If you're struggling with utilization on your credit report, because utilization is the second biggest factor on your credit report in the five factors that is on your FICO, your Vantage score, which is what the credit bureaus basically have their own, which you usually see in Credit Karma, that has six segments as opposed to five. And your utilization is calculated different there, but FICO is the most important one. And that covers more than 160 points on your credit in your credit score out of the 550, 30%. So it's very important that you have your utilization down at a certain level. There, I'm going to walk you through in this video several different ways that you can accomplish this and get your utilization down, because that is one of the most crippling segments of your credit report that we run into a lot of problem with, especially in this time where the economy is bad. So in this video, I'm going to walk you through different approaches to dealing with your utilization. Welcome back to Credit Nerdery, brought to you by Kyrenic Financial, Kyrenic Credit Products, and CheapDIYCreditRepair.com. Welcome back to Credit Nerdery. All right, so utilization is the second biggest segment, responsible for the second most amount of points on your credit report. If you have your utilization together and you're maximizing it, and your payment history is at 100% and you're maximizing it, just those two segments alone and your regular 300 base credit score combined will take you into the mid 600, basically put you into a fair standing with your credit score. So that is how important your utilization is. If you maximize those two segments, you will be in the mid 600 on your credit score. Now, utilization has to do with how much debt you have and how much of that debt you are using, right? The segment of your utilization for most consumers usually just has to do with the credit cards that they have, because most consumers, that's the predominant debt that they have, apart from a mortgage or a car loan or a regular installment loan. The other kind of loan that factors into your utilization, if you have it, would be line of credit. If you have line of credit, it would be factored in, because the line of credit is a revolving. So the utilization right there usually works with your revolving, but because for the most part, most individuals don't have line of credit, it's usually just their credit card debt that is showing there. For the most part, you want to keep your utilization under 30% of the debt that you have available to you. So if you have $1,000, unless you're gonna pay off that $1,000 each time your billing cycle come around, you want to make sure that you keep it. If you're gonna carry a balance, keep it under 30%. Ideally, you want to be under 5%, and you would maximize your utilization segment. Most individuals not going to be under 5%. Most individuals carry a balance. So once you're carrying a balance on your revolving accounts, which would be what is calculated in your utilization, you want to keep it below 30%. Once it goes above 30%, it's going to impact your credit score negatively. But there are ways for you, if you find yourself into a crunch where you don't have a lot of money and you have a lot of debt, and you want to basically balance out that segment of your credit. There are several ways that we can accomplish this. For the most part, this is one of the easiest ways to do this. And this also works if your credit is young and you want to add age to your credit. What I'm going to tell you plays two key roles. It basically can help the age of your credit, and it can also stagger your utilization. If you know someone, if you have a family member, your spouse, your partner, your children, or even a close friend, and they're willing to help you out, and they have, say you have $1,000 in debt, or $5,000 in debt, and you are over 30% on it, and you want to carry down your utilization, and your utilization is very high, what you can do is ask that person to add you as an authorized user to their credit card. They don't have to give you a card. You can tell them that don't give me a card. I don't need a card. You can let the card be mailed to you and you just destroy the card. All I need is just your credit account to be showing on mine. Now you have to make sure when you do this that this person is responsible. And if they have a lot of debt against that credit card, it will defeat the purpose of why you're asking them to help you. They gotta have a good payment history against this account, and they gotta have low utilization on it, so that when they bring it over and add it to it, it will show on your credit report, and it will also help out to stagger out your utilization. Let me give you an example of how this works if you are not clear on it. Say you have a credit card for $1,000 to make it simple, where the math becomes simple, and you use $600 out of that $1,000. You would have a 60% utilization, which would be negative on your credit report. If you have someone that have a credit card that basically have 2,000, 3,000, 4,000, 5,000, 10,000, whatever it is, they can add you to that card as an authorized user. Now that $600 would not be calculated now against your only your $1,000. If they add it to a $5,000 card, that $600 would now be calculated against a $6,000 card. That would carry your utilization down significantly below the 30% mark, carry you down to 10%, right? Because if you have $600 of 6,000, now you're down at 10%, and you are in the ideal range of maximizing that score. So that's one of the ways that you can do it. Another way that you can do it, there are credit builders credit cards that are out there on the market. These credit cards are not traditional credit cards. For example, there's a company that is called Ava, which I usually recommend to my clients to use. Whichever, I have no affiliation with them, so to tell you about them here, I don't get anything from them to do that. So I'm just telling you for educational purposes. Ever has a line of credit. It used to be 4,000, but they cut it down now. The credit card, rather, they cut it down now to 2,500. They don't use your credit report to determine whether they're gonna give you. They usually use your bank account data. So that you would sign up for them, you would attach them to your bank account. They would analyze the data from your bank account and determine whether they're gonna give you 2,500, 1,500, or whatever they determine from their algorithm. When they usually turn you down, if you are carrying a lot of negative in your bank account and you have negative info there, they sometimes deny you. So I've seen they have done that. And sometimes they will give it to you, but they don't give you the whole 2,500. And then what they would do, report that account on your credit report, but instead of you have a credit card that you can use and run up, they report that 2,500 and 1,500. And each time you pay them, it's subscription based. I think they charge about $9.99 a month, which is about $10. And they report you when you make that payment to them as a credit card payment, and that stay positive against your history. That 2,500 or 1,500 would go on your credit report and calculate it in your utilization right here. You would not get an hard inquiry against your credit report when you get that account open, which is something that is helpful. Because the more hard inquiry you have, is the more it affects your credit report. Each inquiry, hard inquiry, lasts for 2 years, even though it should be 1 year, as you hear me say in several of my videos. When they do that, they allow you, they give you probably about $25 or $30 out of the money that they have there, so that you can use to pay for specific services. They don't allow you to use it for anything. It can't be used for regular purchases. It usually can be used for subscription-based products like your Netflix, your Amazon, and so on and so forth. And each month you use that, then and you pay it back, it will be reported again as credit payment history. And that would allow you to have that $1,500 to $2,500 against your utilization, and that would stagger it out, and you can't really use it that much, so you wouldn't fall yourself into danger of going over the limit and make your situation worse. As I said, it's a subscription based product and they report. You don't get an audit inquiry, they report to all three credit bureaus, and that can be a way if your utilization just need a top up. You have more products like this that are out there. If your credit is also, they offer installment loan if you want to diversify your credit profile as well. That is the same subscription based, which is a secure loan, and they do the reporting for you on your credit report. So those are the ways that you can stagger your utilization. Another way that you can do it, but you have to be careful how you do this because Chase and banks like these can basically do damage to you when you do this. What you can do, you can get a loan, a personal loan or a line of credit, and use that to, I wouldn't even say a line of credit because a line of credit then would also be factored into your utilization. You can get a personal loan, which would be an installment loan that doesn't factor into your utilization, and take that loan and pay off the credit card and bring down the utilization, and then just make one installment payment each month that is not affecting your utilization, and that's how you fix it. But what you have to do when you get this loan, especially if you have a significant amount of money, you need to make sure that you don't rush and do this when you get the loan. Because I have done this before and it affected me negatively with Chase. And Chase is notorious for this. I had Chase accounts that I was planning to make some moves, and I had to make sure that I carry down my debt in order to balance up my utilization to bring up my credit score. And what I did, I took out a personal loan and then used the personal, this was some years ago, and then used the personal loan to pay off the credit card debt. So I basically move around the debt. What Chase did, because every couple of months your creditors run your credit report to see the health of your credit, and then use that information to determine whether they still want to extend credit to you, or they want to increase your credit limit, or they want to decrease your credit limit. What ended up happened when I actually paid the loan, because I made a big payment, which was not how I usually pay my credit cards. I would make my payments sizable, not massive, but never pay the minimum payment, pay more than the minimum payment, or several $100s. So these credit cards was thousands of dollars in credit cards. So what I did, because I made that sudden big payment and pay off the card, Chase went and pulled my credit and saw that I actually had a loan that was freshly minted. And what Chase did, they took away 80% of my credit limit. 80%. Their argument was, I did not come out of debt, I just move around the debt, and that is basically a risk factor, and they took it away. But what I would have done different, learning what I learned years ago from this, I would take that same loan, but I would break up that payment, set it on auto, put it in an account that is separate from my regular account, set it on auto, and pay probably $1,000 or $2,000 or whatever it is, depending on how much you owe, each month or multiple times for the month. So the payments going incrementally as opposed to just one big payment, so they become suspect and then damage you like that. So these are the ways that you can stagger out the utilization. Let me just do a quick recap so you remember what I covered. If you have utilization issue and you want to bring them down, there's 3 different methods that you can use. There are others because you have also loans that are specifically built to help you pay off credit card debts, and the companies market themselves that way. But sometimes they are a bit more tedious, and the interest rate is a much more higher than the 3 ways that I've given you. So that's why I don't really mention them. But you also have that option that there are companies that specifically specialize in helping you to pay off credit card debt. I'm not talking about loan debt consolidation companies. I'm talking about loan products that are specific to that. So what we covered in earlier is, 1, you can ask your friend, family, or someone that is close to you that trusts you to add you as an authorized user, but make sure that they have good credit on the account that they're going to add you, and it's significantly more than what you have, so it will carry down your utilization. You don't just want to be added to a card. and you want to make sure too that they are basically paying that card good, because anything that they do on that account, it will be reflected on your account. So if they miss a payment, it will show up on yours and it will make your score worse. So you want to make sure that this person have good credit habits, and they're gonna make sure that they maintain good payment on it. And you add yourself as an authorized user, and as a result of that, that will basically show up on your credit and bring down your utilization. The next step is, if you don't have that option, you can actually get personal loan and use that personal loan incrementally pay off the credit card. Don't take the money and then go and spend it and not use it to do what you do. You're using a strategy. Use a personal loan, but as I said, don't just make a lump sum payment, because some of the banks look on that and they can take away credit from you and make your situation worse. And now you have that new debt and you did not accomplish what you need. The next way that you can do it is to pull a personal, no, I just give you the loan. The other way that you can do it is to get a product like Aver, a credit bill, a credit card, but you want one. And why I usually recommend Aver is because the amount that they give you. They give you up to $2,500 against it, and that is basically a lot. Self and Kickoff also does this, but their amount is not as large as what Aver gives. So that's why I usually recommend Aver over them. And Aver reports to all three credit bureaus. Like I said, it's a subscription-based credit card. It's not a traditional credit card. It's built specifically to help you build credit and with the payment that you're reporting, and that credit limit can be matched against the utilization and bring it down. There are more companies that does this, but I usually don't recommend many others. You can do your due diligence and find companies that does this, and you will be in good sign. All right, so those are the ways that you can bring down your utilization.